what I would always say to the first part is life insurance contract, whole life contract, based on how you build it, it's always going to have cost, but that cost is limited. We'll prove that in great detail in a moment. And you want to know, what is that cost?
Right.
How long does that cost last? What does it actually buy? And what's the potential equivalent return on everything that you
Yep. I think one thing else, and it sounds like we're going to dive into that later in our conversation, but when you look at a life insurance illustration, those things are all already built in. So it's not one of those things where you look at an illustration, you're like, well, you're not showing me the whole picture. It's true that over 30 years, the illustration will be wrong for better or worse, but they are factoring in, and the guarantees section's factoring in with guarantees built around the actual cost. And so all your talking points, commissions, cost of insurance, all of that is already baked in. So in a way, it's very transparent because you can see, in a lot of cases, the worst case scenario on an illustration with all the costs. So we'll take a look at that. And I think it's that for me, going through truth training and understanding like how illustrations and how life insurance is built, really powerful for my development.
I'd comment on one other thing. So when people are talking about costs, they say there are insurance costs, there's also administrative costs, and then they say, and commissions. I don't even know why that's a concern. It's built in here to begin with, but there is a cost in the contract to put the policy in place. There are commissions in general paid from the general fund of the insurance company by separate contract to those who refer the business or offer the business. And so to point directly at a commission as if it's a bad thing, I think is a very wrong approach.
Yeah, if I'm looking at an illustration, one versus the other, and let's say it's the same company, I should care about the illustration and what it's doing for my family. It shouldn't be like, well, Trent's getting paid more on this one, which inherently makes it bad. At the end of the day, the illustration's the illustration. If the insurance company will pay whatever they want to pay, but it's not. It's like interconnected kind of, but once you see an illustration, it has really no bearing. It's no bearing. Yep. All right, next question. Enjoyed the discussion. The suggestion was made the whole life policy will save you in term policy premiums, but you would need many years of paying whole life premiums before you could even get close to the level of coverage in term policy. If you have a term policy to bridge the gap, whole life really doesn't save on term premiums.
I don't think that's what we said. I think that's one of those that's a little bit misunderstood and out of context. What we said is if you look at a holistic approach, dollars that are coming into your financial model, where you're going to put money in the areas of protection, savings, growth, taxes, debt, expenses. If we use exactly the same amount of cash flows in total, and we reposition those, then if we have the permanent insurance, we don't have to buy the term insurance.
Yes.
We buy the investment or savings or whatever, we have to buy the term insurance for the protection to get there for an ultimate zero, right? Because if the plan is to live beyond the term, then you're guaranteed, and by choice and design, to end up with no life insurance, right? If both scenarios from a cash flow standpoint were exactly the same, and I ended up at that retirement age with death benefit and savings and cash and all the retirement accounts, if they cost the same, but one has a death benefit and one doesn't, which would you prefer to have?
Death benefit.
Every time.
And another way, I'm just simple when I'm thinking about this, but if you have person A who agrees that they need $1 million of coverage and person B that agrees that they need $1 million of coverage, I'm saying the need word, which is not good, but let's just keep it simple. Person A puts their money into a high yield savings account and then takes a portion of that to pay the term premium. Person B is putting money into a permanent policy, which buys, let's say, half $500,000 of death benefit already built into that. And so that by definition, they will spend less on the term policy to make up the difference. And so it's one of those, okay, long term, you can compare the high yield savings account versus the life insurance. And let's say they are identical, which in a lot of cases, life insurance will actually outperform the high yield savings account. Well, let's just say they're identical. Well, one's coming with an extra benefit that's not factored into the high yield savings account. And so if the internal rate of returns or rate of returns are identical, it's actually not identical because one's giving you more benefits than others.
Right. And then there's other costs associated to that conversation.